Hi, my name is Stephanie.
I got your name right. Sorry.
Yes, you did.
I didn't even say your last name. I practiced it. She got married, what, a year ago?
2 years ago.
Oh, gee. I still can't get her new name right.
No. Thanks, Jane. The three of us are from the firm Wiebe Hinton Hambalek. We are a traditional CPA firm. We love supporting the Institute for Family Business as we work primarily with closely held and family businesses as well. Just to do a little housekeeping and introduce you to the firm, I want to take you through the packet that you should have in front of you. If you don't have a folder, make sure that you grab one. There's some brochures about our three industry niches. We primarily focus in the real estate, construction, and closely held business arenas, as well as agriculture. For today, also in your packet is a copy of the slides with some area for you to take notes. Behind that is a survey that we will complete at the end of the session, and the extended tax guide that follows along with the PowerPoint. So the PowerPoint is sort of a simmered down version, and if you need more details on any of the topics, it should be in that booklet for you. I'd like to introduce today our two speakers. First, we have Chelsey Marderosian. She's a manager with our firm and has been with us for 4 years. She's been a CPA since 2012, and she has a strong background in agriculture in the Valley through her family. She specializes in real estate and real estate partnerships. Then we have Nichole Agrava. She's been with the firm for 2 years and has been in the accounting industry for 6. She specializes in our construction and rental real estate clients with also a strong specialty in partnerships. Also in the back, before you leave, if you do want a copy of the slides in a PDF form, be sure to grab one of those flash drives. They're on there as well. And with that, I will turn it over to Chelsey.
Okay, welcome everyone. Today we are going to be touching on some tax planning items and some opportunities that will be available to you. Some of the things you're going to hear today are going to be maybe familiar to you as they haven't changed from previous years, and others you may want to take advantage of as they're set to expire in the next few years. With the election last night, I'm sure a lot of you may have some questions on what we can expect, and we will touch on that briefly at the end of our presentation. Also, I want to note that we want this to be an open discussion, so if you have any questions, feel free to interrupt us. We'll also be taking questions at the end. The goal for today is to just present you with the opportunities available for you. Some are going to apply to you, some won't, but we really want you to take them away and, consider them and consult with your CPA or tax advisor. And with that, I'm going to introduce Nichole, who's going to get us started.
Thank you, Chelsey. Okay, so let's move past that. Thank you. Okay, so let's start. We're going to talk about some tax planning basics. And a lot of tax planning basics, we're talking about saving tax, deferring tax. We need to think about timing. And timing is not just how can I defer tax or defer income or defer expenses or whatever. It's also what can I anticipate, what can I bring forward, what can I accelerate. So there's a lot of different things. We have income items, bonuses, consulting, self-employment, and you're thinking, why would I want to accelerate income? Well, one of the clients I work with, he's a commission-based real estate sales. So every year, about November, December, he's starting to look at his commissions and say, okay, I've reached my maximum percentage. I'm getting the most out of this. Do I want to recognize these last commissions now, or do I want to push them into next year so I can get to my maximum percentage sooner? He's also looking at next year, I'm anticipating selling even more. So I want to try and balance my tax liability. So he may try and accelerate some of that. Or he's saying, I'm making more this year, but I know next year will be a smaller year. So he's going to try and defer some of that just to try and balance that load. And really, it's dependent upon each person's situation. That's just one example. You can also try and accelerate or defer your retirement plan distributions. The caveat, the thing you need to watch out on, though, is you can't defer ones that are required. So if you're over 70 and a half, you have a traditional IRA, you have to meet your required minimum distribution. You can't pass it off into next year or you get a penalty. But if you're under 59 and a half and you want to take a distribution, you may be subject to early penalties, in which case, it would not be a bad idea to try and push that off into the next year. You can also accelerate or defer certain expenses. Some of them are deductible, like your state and local income tax, property taxes, charitable contributions. And a lot of people think, oh, I want to try and get as much as I can into the current year. It's not always applicable to your case. You may be subject to what's called the alternative minimum tax, which I'm going to touch on briefly in just a minute or two, in which case it doesn't always make sense to try and accelerate your expenses. You're not going to get a benefit from it, so you might as well defer it until after December 31st. Also, if you have income properties that you're looking at selling, well, you know what? I don't want to pay tax on it now. Okay, ideally, we never want to pay tax on it. We know that's not going to happen. But we have options that you can discuss with your tax advisor. You can look at an installment sales agreement where you're getting a little bit of the income every year, so it's not such a big hit. You can look at doing a 1031 exchange where you're deferring the tax into a future period when you sell the replacement property. Bring it all up together, what I'm saying is that you have a lot of options that you need to consult with your tax advisor to see what best fits your situation in terms of trying to time income and expenses. Okay, so the AMT, alternative minimum tax. I'm not going to get into a lot of details. AMT is complex. Some people end up getting hit by it all the time. Some people never get hit by it. You never know until you talk with your tax advisor if you're potentially subject to it. What you do need to know is if you think you might be, or even if you don't think you are, you should check with your tax advisor, with your CPA, because if you are subject to the alternative minimum tax, certain deductions like local and state taxes, property tax deductions, those get limited on your tax return. You don't see as big a benefit. You also have adjustments for depreciation on assets, which means that you may not get as much depreciation as you think you should. So if you sell something, your gain may be higher or your loss may be lower. And so you just need to be aware that any year you can be subject to it, even if you weren't before. So you should always be in constant contact with your advisor just to see, hey, where am I in terms of the AMT? Another deduction that you can try and talk with your advisor, see if it applies to you. Not a lot of people are aware of it, or that they may even be able to use it. If you work from home, the home office deduction. This means that you work from home for the benefit of your employer. You don't even have to do it all the time, but you do it enough that you have a sole dedicated space to your home office. You don't have any other use for it. You may be able to take a deduction for certain home expenses like your mortgage interest, your property taxes, utilities and insurance, but you can't just say, okay, I want to take the home office deduction. Talk with your advisor, say, what are the rules? What do I have to do to qualify for it? And your advisor can advise you on the best way for you to utilize it, or maybe it's not even something that applies to you in the end, but you never know until you ask. Now, home sales, it's not so much about timing, but it is about planning. Some people will say, I really want to sell my home. It's too big. I don't want to pay tax on the gain. We have this great exclusion that we can utilize. So if you're selling your principal residence, a lot of people know it, but some people still don't, that you can defer some of the gain. So if you're single and you sell, you can defer up to $250,000 a gain if you meet the requirements. If you're married filing joint, you can defer up to $500,000 worth of gain. So being afraid of the gain is not a reason to defer or not sell your home if that's what you're looking to do. And if you're married filing joint and you get more than $500,000 gains, I want to know your secret in Fresno, because that still can be tough to do. So that gives you a lot of room to play with. Now, the good news is the gain that qualifies for the exclusion is also excluded from NIT, the net investment income tax. So that will also help reduce your tax liability. And Chelsey will talk about the NIT in a little bit. Now, the bad news. Losses on your principal residence aren't deductible. I know we wish they were, but unfortunately they're not. If you have a second home that you're thinking of selling, bad news is the second home is not eligible for the exclusion. That's where you want to think, okay, can I turn this into a rental? Turn it into an income property, a business property, which case then different rules apply. So you would want to consult with your tax advisor. Also, if you know you're going to sell your primary residence and you have this second home that you're trying, do I want to live here or not? It's a vacation home. Make it your primary residence. Talk with your tax advisor. You may then down the road be able to defer that gain under the primary residence rules. So it's not a total loss. Now, we're not going to get into a lot of specifics about the energy-related breaks. There's a lot of them. Some of them are complex. Some of them are more simple. But what we can tell you is that a lot of the breaks were extended through at least 2017, some even beyond that, including the one for solar energy. These credits, which can be up to 30% of the cost of an energy-related expense, help reduce your tax liability. Now, for some people, they think, I don't have any tax liability this year, and it's so short in the year. That is true. We're, November 9th? So it's really hard to say, I'm going to get a solar system up and running before December 31st. But now's the time to say, talk with your tax advisor, say, hey, what are my options here? Plan for 2017. Get it in place, and hey, maybe next year, your liability is high enough that you're going to end up eating up most of that. And even if you don't, those energy credits, those carry forward to help continue reducing your tax liability. So it's another planning tool that's at your disposal. Okay. Charitable donations. It's a great tool. Not just for trying to defer tax or reduce your tax, but also to give back in general to society. The thing is, like we say, they're easy to make. The key is you need to be able to substantiate them. By substantiate, copies of checks, credit card receipts or letters from the charities. The thing to be aware of is there is a limitation on your charitable donations. We don't get to take a dollar for dollar reduction. It's an itemized deduction, and it can't exceed 50% of your adjusted gross income. Adjusted gross income is your income items like your wages, interest, dividends, any partnership income, less certain above-the-line deductions, things like HSA credit, which I'm going to discuss in just a minute, self-employment taxes, self-employed insurance, and things like that, to get down to your adjusted gross income. So your charitable donations are limited to 50% of that number. Anything above that will carry forward, but it doesn't carry forward indefinitely. So you really do want to work with your tax advisor to plan the best way to utilize your donations and make sure you don't lose any available donation credit to you or deduction. Yes, now quick warning, charitable deductions, they are allowed for AMT purposes, but your tax savings may be less. You don't see as big a benefit when you're subject to AMT for your charitable donations. Doesn't mean don't give, just be aware you may not see as much of a savings. Health savings accounts. I love these. These are great. Health savings accounts are when you have a high deductible health plan, you're not part of an HMO, and you want to be able to put money aside to help pay for your out-of-pocket expenses. It can either be set up through your employer. Usually that means it's going to be pre-tax. The great thing is that means it reduces your taxable wages. I know on my paycheck, my contributions help reduce the amount of wages that get subject to tax. Love it at the end of the year. You can also make deductions, or contributions, I should say, to a plan that you set up yourself. You're self-employed, you have insurance through your self-employment, and it's a high deductible. You can set up an HSA plan, make contributions, and you potentially can get an above-the-line deduction to reduce your AGI. Reducing your adjusted gross income means you're going to reduce your taxable income. It is subject to the limits as listed, but it's a great tool that you want to check with your tax advisor to see, one, with the health plan I'm under, is that an option for me? And will it help me defer or save tax? Now, itemized deductions. Itemized deductions are Schedule A on the tax return. Don't worry, I'm not going to go into the Schedule A. I'm just going to tell you it's things like mortgage interest, property taxes, sales tax or state tax, depending upon your situation, DMV fees, things like that, that get itemized to help reduce your taxable income. Now, the thing is, if you have your income, your adjusted gross income is above a certain threshold, your itemized deductions are limited to 3% of AGI no matter what. That's one of those things you want to talk with your tax advisor. Hey, am I at the point where it's not going to matter what I do, my itemized deductions are limited? So then you're saying, okay, well, if that's limited, how can I best plan that? You know, maybe I don't want to prepay taxes because I'm not going to get a benefit, or I want to try and push charitable contributions to another year where I may not be limited or know that I'm going to have carry forward. The other situation, a lot of the miscellaneous expenses have a floor or a minimum you have to meet before it's even deductible. So sometimes you're thinking, I've got all these miscellaneous itemized expenses, but if your income is so high that you're not going to get there, you need to be aware of that. So you talk with your tax advisor. Just like medical expenses it has to be at 10% of your adjusted gross income. So if your adjusted gross income is $100,000, your medical expenses have to be at least over $10,000 for you to get a benefit on your tax return. So that was the tax planning basics. A lot of it about timing, how, things to think about in talking with your advisor of either trying to push expenses out or accelerate them, and the same thing with income. So let's take it to the next step. That was on a personal level. Let's think about our family and education. What are some of the ways we can save money or install a lifelong savings plan? And then there's a lot of things that are listed in your pamphlet. I'm going to focus on two. First off is IRAs for teens, and I think this is a great tool, a great way to start teaching the younger generations to save for lifelong purposes. They have a lot of years of tax-deferred growth. So if your son or daughter works for your company or has their own outside job, they are eligible to contribute to either a traditional or a Roth IRA up to $5,500 or 100% of their earned income, whichever is less. That's a lot of money that they can start putting aside every year. Compounding it over 40, 50, 60 years, depending upon their age, they could have a lot of money saved up by the time they reach retirement. And the other thing is, they don't have to necessarily pay it out of their own wages, or out of what they take home. There is the option where if you're financially secure enough and say, I want you to learn to save, but I understand you don't want to spend your own money to do it, which sounds kind of funny, it can come from gifts. So the family gifts, you can say, you know what, you made $4,500 this year. I'm going to contribute or gift you $4,500 for you to put into an IRA. And that will start setting them up for lifelong savings. The next one I'm going to talk about is education. There's a lot of options for educational planning and savings. A lot of deductions, which I'm not going to touch on just because they are kind of complex and can be hard to qualify for. What I want to talk about is a 529 savings plan. It's been in the news a lot in the last couple of years. It's got a lot of good points. It does have some detractions. Good points. The plan assets grow tax deferred just like a lot of other educational savings plans. Another great point, contribution limits are high. If you're looking at like a Coverdale savings or an educational IRA, you have, when I was looking at them for my son, it was $2,000. I think it's probably gone up since then. But $2,000 to save a year is not a lot of money when you're looking at the cost of education, even for a local school. The income or the limits are a lot higher for 529 plan. And there's no income restrictions. You don't, say you reach $250,000 of adjusted gross income, you can still give to a 529 plan. You reach $1 million adjusted gross income, you can still give to a 529 plan. They don't say, nope, sorry, you make too much money, you can't save for education. There's no beneficiary age limit. A lot of education plans, you can't contribute after they turn 18. Not so with a 529. You control the account. If you're the one who opens it, it's in your name, you control it. So even after your child reaches legal age, it's not their plan. It's your plan for their benefit. So goes into the next one. Junior gets a full scholarship or decides he's not going to college. You're like, what am I going to do with this money? I don't want to take it out and pay taxes on it. So you know what? Sally, his sister, hey, I want to go to school. And I didn't get any scholarships. You can transfer it into her name. Heck, even if you want to go back to school, transfer it into your name. You can transfer it to another qualifying family member, and you're not limited by age. And I think one of the best parts is if you're in a situation where your family is doing really well, grandparents want to be able to pass the wealth down. They can front load 5 years. 5 years worth of the annual gift tax exclusion into a 529 plan. So if that's what, 14,000 times 5 that they could give at one time. They could set themselves up for a large amount of money that can then grow and just keep growing. And I think that outweighs the fact that the contributions aren't deductible on the federal level. In California, they're not deductible. Some states are. And it's not on here, but one of the other things to think about is you're not limited to a state that's sponsored by your plan. So you can actually shop around to different states' plans for the one that fits your income or your, I should say, investment profile best. All right. So I've talked about tax planning basics and timing, talked about family and education, and now we're going to move on to Chelsey, who's going to handle some investment and business planning tips. Chelsey?
Thank you, Nichole. Okay, so the first thing we're going to talk about are investments. And as it says here, it is no easy task. Oftentimes it's something that you want to consider with your, if you have a brokerage account, you want to consider with your brokerage advisor as well as your CPA. But the first thing we're going to touch on are capital loss carryovers. Now, the important takeaway here are these carryovers they carry over indefinitely, meaning they do not expire. And you might ask yourself, how can this help me in terms of tax planning? So, for example, let's say I sell some stocks that I had for a $50,000 loss. They weren't doing well. I cut my losses when I did. Now, if I'm married filing joint, I can deduct $3,000 of those losses this year, assuming I don't have any other gains that would offset, and the rest would be carried forward to the next year. Now, knowing I have those losses, maybe that's time for me to, think about, I've had that investment property I've been thinking about selling. Maybe now's a good time to sell it. I sell that for a $100,000 capital gain. Those losses that I had that carried over will offset that gain and help reduce the tax impact. So that is the big takeaway from capital loss carryovers. Now, the net investment income tax. I'm sure many of you have heard about this before. This is not something that's new. It's been around for a few years. Essentially, it's a 3.8% tax that is applied to your net investment income. And it's important to note that this is an additional tax to the regular tax calculated on your taxable income. Your investment income can include interest, dividends, capital gains and losses. If you have flow-through activity coming through on K-1s, that is all considered your investment income. And as you can see here, there are some thresholds to consider. So on this subject, the strategies that can help save or defer income tax on the investments might be the timing of the capital gains and losses that we talked about, and will also be the business planning strategies that we'll touch on next. So for your business and your self-employed, this is probably going to be I don't want to say easiest, but it will be an easier section to apply a lot of these tax planning opportunities for and give you a great benefit, especially as we come towards the year end. So we have 3 types of depreciation-related tax breaks available here. We have bonus depreciation, and this is extended through 2019. As of right now, it's set to expire after that. There will be a drop off. Right now it's 50%, and it will start dropping off in 2018. We also have Section 179 expensing. As you can see here, the details on that, that is scheduled to be permanent. And we also have accelerated depreciation, which allows shortened recovery period of 15 years for qualified leasehold improvement. That is also scheduled to be permanent. So it's important to note here that these items can apply on equipment or property that you may have purchased already during this year. It may not require you to make any other additional purchases towards the year end in order to get some tax planning opportunities and breaks here. It also may be something that entices you, hey, I'm going to go out and I'm going to, spend money knowing I can get some bonus depreciation or 179. It is important to consult with your tax advisor on these items because, as you can see, each offers a different benefit, and you want to pick the benefit that's going to be greatest for you and for your business. So other asset-related issues. A few years ago, the IRS issued final regs for tangible property. The costs incurred on the incidental repairs and maintenance can be expensed and deducted immediately. That is the big takeaway from this. So for example, I have a client who last year made some repairs on the roof of his business. The repairs were about $70,000. Now, doing the analysis on the factors of that repair, as well as in line with the tax regs, he could take that deduction of $70,000 immediately in that year, rather than, in the past, he may have had to capitalize that repair and depreciate it. Another thing to note here is the de minimis safe harbor. That is an election available year to year for taxpayers that allows a $2,500 deduction on repairs per item per invoice. So this is a big tax savings for people. It does not require any written policy to be put in place, although it is recommended, and it is also under the assumption that you've had this in place during the entire year, meaning you want to be consistent on it. You can't pick and choose when you're going to use it. If I have audited financials, that $2,500 goes up to $5,000. But in that case, I do have to have a written policy put in place at the beginning of the year. So at this time, it's probably not something you can take advantage of in 2016. However, you do want to get that in place for 2017. And then we have the cost seg study. So if you're looking for big deductions, this may be the item for you. It does require a lot of planning. So considering we're almost at the end of 2016, it's probably not feasible to complete by year end. But it is something you want to plan for 2017. It's going to require planning, consulting with your tax advisor. You're going to need an expert in cost segregation to get this report for you. And essentially what that does is it identifies property components and related costs that can be depreciated faster, meaning you're going to get better deductions earlier. We recently had a client who did one of these cost segregation studies on a building that was $20 million, I think it was close to that. And the deductions during the current year were close to $4 million.
I have a question.
Yes.
About the cost seg study. Does that require a certain certification to be able to do a cost seg study? Or can your CPA do it?
Well, in our business, we do a certain type of cost segregation, very low level in terms of when any property is purchased to help get, increase the 5-year property. However, if you're looking for those big deductions, you do want someone who is, licensed to do them to get the full report. It does hold up better under, if you were ever audited, the cost seg study is a very good thing to have and the IRS will approve of. No problem. So we have vehicle-related deductions. If you are self-employed, own your own business, and use your vehicle, then you can take advantage of some deductions. You have actual out-of-pocket expenses, or you have the mileage deduction, which is 54 cents per business mile. My sister-in-law she travels a lot for work. She is a sales rep for clothing lines, so she's always on the road. So for her, the mileage is a better deduction for her. So I tell her to keep track of her miles. She doesn't have to worry about keeping track of all her other expenses. So it is important to consider. If you're traveling a lot, the mileage deduction probably will be better for you, but it is important to consult with your tax advisor to determine if that's the best option. So as we're getting close to the end of the year, a lot of us may be looking for those extra deductions to help limit or reduce our net business income. And that can come in the form of purchasing a new vehicle. A purchase of a new or used vehicle may be eligible for Section 179 that we touched on earlier. So that means big deductions. However, it is important to note that depending on the weight of the car and also the business use of the car, your deductions may be limited. So again, consult with your tax advisor. So you see a warning, the depreciation limit is reduced if the business use is less than 100%, which we mentioned. If business use is 50% or less, you can't use Section 179 expensing or the accelerated regular makers depreciation methods. So the Affordable Care Act, the play or pay provision. So this is something that was set in place or brought in a few years ago as part of Obamacare. We're not going to touch on it in great detail, mostly because it's very complex and we could spend, hours talking about it. But the important thing to note here is, there is a penalty imposed on large employers. And a large employer is one that has 50 full-time employees or the equivalent. So that means that there's a calculation done that takes into account both full-time and part-time employees. So you do want to take that into consideration. But essentially, if you are not offering minimum essential coverage, or if that coverage is unaffordable, you may be subject to that penalty. So what you'll want to do is a lot of payroll providers will do the calculation for you to see if you are considered a large employer. We have a client who's currently using that through their payroll provider. I believe it's Paychex. And you'll also want to get in touch with your insurance provider to make sure you're offering the right amount of coverage. So we won't go into the calculation of the penalty. There are a lot of factors involved, but the one important takeaway is it is a significant penalty and can often be unexpected for those of us who don't plan for it. So this is warning, IRS may issue additional guidance or transitional relief, or Congress could make changes to that law. So that is a possibility, considering we have a change in presidents coming in January. So next we're going to touch on a few tax differences between business structures. And this is important. We've touched on previously a lot of deductions and tax planning opportunities that may be related to existing businesses. But it's also important to consider, using a different type of business structure, considering one for new businesses as a planning opportunity. So the two structures we're touching on here are a flow-through entity or a sole proprietorship and a C corporation. We have a number of differences that are listed above. The main one being there's some differences in some tax rates, how it's taxed. The C corporation files its own tax return. That's where, it's taxed. And then whereas a flow-through, you'll get a K-1, and you'll be taxed on it on your individual return. So again, number of factors to consider. It may be, when you're looking at planning a new business and picking a business structure. It may be the tax rates. It may be liability protection. It may be the type of business that you're running. All these things you want to consider. It's not a decision that you can easily make on your own, so you definitely want to consult with your tax advisor to see what will be the best option for you. And self-employment taxes. So if you are self-employed, a lot of you may be familiar that you have self-employment tax, that this is an additional tax in addition to your regular tax that you pay on your taxable income. However, I do have those clients each year that are a little shocked by it. They are paid, through a 1099 instead of a W-2, and they have all this tax at the end of the year, and they, wonder what happened. And, I just explained to them where, like you would a paycheck, you have payroll taxes taken out. When you get a 1099, they don't, so it gets taken out at the end of the year and applied to your tax return. An important thing to note here, the thresholds. 2016, it's currently $118,500, but there's a big jump in 2017 to $127,200. So that is a big difference that you'll want to consider, especially as Nichole was talking about accelerating or deferring income. So in addition to the tax, you do have some opportunities for some deductions if you're self-employed. You have, 100% of health insurance costs up to your net self-employment income. You have contributions to a retirement plan. Timing is important here. It does not have to be made at year end. It's made with the due date of the tax return. And then there's also contributions to an HSA, which Nichole previously touched on. You also get above-the-line deduction for the employer portion of the self-employment tax made. So you do get some tax deductions and some breaks if you are self-employed. So that kind of leads into Nichole is going to touch on retirement.
Thank you. So we've talked about, on an individual level, some planning basics. We've talked about family and education, investment planning, business planning. So what's the next logical step? We're going to talk about retirement. And this could be whether you're going into your golden years or you're trying to plan ahead for your golden years. So I love it. Making golden decisions about your golden years. Very true. You want to make good decisions from the get-go and continue making good planning decisions. So retirement in 2016. Retirement in any year, really. As Chelsey said, if you're self-employed, you have options for retirement plans. You don't necessarily have to set up the plan or fund it by year end, but you need to start planning. Talk with your tax advisor. Talk with your financial advisors. What are my options? How can I get the most bang for my buck in terms of contributing to a retirement plan? And you can know, okay, this is what I can do, and then you can start planning and getting the money put aside so that when you file your tax return, then you can fund your retirement plan. You also need to think about at this point, so we're just at the beginning of November, we're getting towards the end of the year. You have a required minimum distribution if you're age 70 and a half, if you have a traditional IRA. You need to make sure you get that distribution in before the end of the year. If you fail to make it, they assess a penalty. If you have a Roth IRA, you don't have that required minimum distribution, so you can wait until you're ready to take funds out. You also, and I mentioned this earlier, if you're saying, hey, you know what, I've got this large nest egg, I want to take money, I want to retire early, but I'm 58, or I just turned 59, I'm not 60 yet, or I'm not 59 and a half, you need to be aware. Early withdrawals before 59 and a half may potentially be subject to a 10% penalty. You want to check with your advisor and see if that will apply to you, and that's above and beyond any other additional tax or penalties that you may experience. So it's really important through this whole retirement planning process, whether you're gearing up for the future or, hey, I'm in retirement now or getting close to it, to see what your options are, what your limitations and restrictions are. Otherwise, at the end of the year, you can end up having to write that check and going, I wish I had planned better. Now, so retirement plan contribution limits. 16 and 17, there's no changes. The important thing to take away, traditional and Roth IRAs, your regular contribution is $5,500. If you're over 55, I believe it is, the catch-up is $1,000. Now, the thing to keep in mind, all the regular contributions are pegged to inflation. So they may or may not go up from year to year depending upon what the economy is looking like. The catch-up contributions are set by law. I would not anticipate them changing unless Congress or the IRS enacts some regulation to change that. And you can see with 401ks, it's $18,000, and simple plans, it's $12,500. And then, of course, you can kind of tell that the catch-ups are kind of in line with terms of the size to the actual contribution limits. So if you haven't already made your contribution to your IRA, you still have time. You can talk with your advisor which option is best for you. If you don't even have an IRA opened up, do you want a Roth or do you want a traditional? Talk with your tax advisor. They can tell you based on your situation which one will fit best, because traditional sometimes has tax benefits, but not everyone qualifies for them. And a Roth has benefits down the road. So again, that's where keeping in contact with your advisors is exceptionally important. Now we move on to after retirement.
Well, hopefully before retirement too, you're planning. Yes. So as you can see, there's kind of been a trend here. We're going from the here and now into retirement, now into estate planning. But it's important to take advantage of the opportunities now while they're available. You want to start planning now. It's not something you want to do years down the road, when it may be too late. Something you want to constantly revisit, consult with your tax advisor, consult with your attorney, and you want it to always be a discussion. So the estate tax, you can see the rate is 40%. It is scheduled to remain at that level. The current exemption is $5.45 million for 2016. It does adjust for inflation annually. Back in 2012, with the $5 million exemption, there was a big push on, gifting, which I'll touch on next, and the estate tax. A lot of people took advantage of that exemption. As the exemption increases each year, again, it is important to revisit and consider, maybe you want to make additional gifts or changes to your estate plan. So as you can see, review your estate plan in the light of the changing exemption. That's what we touched on. It does avoid unintended tax consequences, meaning the estate tax, and you want to make the most of the exemption in plan. So gift tax. Gift tax does follow the same state tax exemption and the rate. Your gift tax exemption that you use during your lifetime does reduce the exemption available at death. So again, when I mentioned a lot of people were gifting utilizing the $5 million exemption in 2012, that's what they were utilizing. So it is important, again, to revisit, different items you may gift. It could be cash, could be investments in a partnership. It could be property that you think is going to appreciate years down the road. So consulting with your tax advisor and any attorneys will help you utilize that exemption and utilize the annual exclusion of the $14,000. It is important to also remember that it's $28,000 for a husband and wife. They want to split the gift. And this is only annual. It does expire, but it comes back again the next year. So you can take advantage year after year, but it does not carry over. So with the exemptions and the exclusions, there really isn't a reason if you're planning that you should have to pay gift tax. So again, consult with your advisors. So again, I touched on that, using the exclusion by the 31st. The generation skipping tax. This is most beneficial if I am a grandparent and my children, maybe I have a wealthy estate, or I have a high valued estate, and my children do as well. So, I'm considering, hey, my children don't need it. Maybe I'm considering skipping a generation and putting it to my grandchildren. This does offer a valuable tax saving strategy tool. However, it is complex. There's a lot of things to consider, analysis that needs to be done, and it may not always be the right fit for you and your estate plan. So again, consult with your tax advisor. So tax smart giving. When you're giving, you may have 3 goals. It may be a few of these, probably won't be all of these because they kind of conflict each other, but the idea is, maybe your goal is to minimize estate tax. So what that means is what I'm going to do is I'm going to gift property with the greatest future appreciation. So the idea is I sell something that has a low value now, knowing it's going to be a higher value later. If I gift it now, my beneficiaries aren't going to have to pay the tax on that. Maybe your goal is to minimize your beneficiaries' income tax. So after you've transferred it to them, you don't want them paying a lot of tax. Then you're probably going to want to gift property that hasn't really appreciated greatly in value while you've owned it. And maybe your goal is to minimize your own income tax. So in that situation, you don't want to gift property that's declined in value. What you want to do is maybe consider selling that property, taking the losses for yourself, and then maybe you're going to gift the proceeds. So the important takeaway from this is you want to identify which goals work best for you and your estate plan, consult with your advisor, and make sure that your plan reflects them. So before we get into questions, we did let you guys know that we would touch briefly on the election last night. And Nichole will get us started with that. Again, this is just going to be something very high level. It is important to know that nothing can be done without Congress and will often take a long time to put in place. So, Nichole?
All right, thank you, Chelsey. Now, the thing to keep in mind, it is potential that they could do something retroactive to 16, but it's not likely given, as Chelsey said, how long it takes. So these are going to be things to think about planning forward into 17, 18, 19. So Mr. Trump has put out through various sources and things some of his vision. We know he wants to change the tax code. He wants to simplify it. He wants to make some modifications, including reduction of taxes, simplifying the brackets. He wants to reduce business tax. He wants to make it simpler and easier for people to invest in business and also pay their fair tax. Would you say that's fair?
Yep.
I don't want to get into too specifics because, again, it has to be, he can make suggestions, Congress has to pass it, and then it becomes law. So we don't want to say we're going to go for these tax brackets when really we don't know what it's going to end up. But we can anticipate that there will be changes. Most likely I don't know if there'll be a simplification of the code, but they're going to try and make it more business friendly, would be my guess. Try and make it so that high wealth individuals are paying their fair tax, but not so much that they don't want to grow their businesses and employ people. Did you want to touch on?
I think Nichole pretty much hit on all the points. I know he did also mention, wanting to give tax breaks for the working and middle class.
Oh, that's right. He one of his ideas was trying to make the child care credit an above the line. Rather than a credit. So there's a lot of different plans that he's working with. And I do know, if you want to talk about the death tax, his kind of goals for that.
Well, you can touch on it.
Oh, gee dang.
You've got it covered.
I know one of his plans is he wants to try and repeal the death tax. So some of that estate tax planning you may not have to concern yourself with in the future. Wouldn't peg your whole plan on that yet. I would still say consult with your advisor. Plan as if it's not going to change. It's better to be safe than sorry. You want to have something in place if these things don't happen. He's talked about wanting to make it easier to get child care credits, trying to make it easier for employers to offer child care and get deductions within their own business tax returns for that. So he does have a lot of ambitious plans to try and make the tax code friendlier to individuals, friendlier to businesses, and also to estates. Now, do we have any questions?
And again, it is important to note that these are just his visions. Does not mean they're going to, come to fruition. And again, like we mentioned, everything has to go through Congress.
Yes.
We offer a service to our clients with contracts for quarterly payments. Sometimes we have clients that decide not to pay us for a month or for a quarter, can we write that loss off because we planned for it, we budgeted for it? Is that possible?
If you're ultimately going to collect on it, then no.
What if we don't collect on it, what if the client decides to break the contract, collect on that last quarter?
You mean in terms of getting
We
income?
provided the service, we
Right.
provided the service, and now we're not getting paid for it. Is it possible to deduct that loss?
I think it'll probably
It's
depend
potential.
on a number
It's a number of factors.
I mean, just because you don't get the income you were anticipating getting does not mean you can write off the loss for it. If that makes sense. But do consult with your tax advisor on that.
How many years in advance do you think the real 79 will remain at 500,000?
It is pegged to inflation, and it's a large number. Honestly, there's no way to tell. They may leave it at that level for a long time, and they may decide to just bump it in increments over a long period of time. We don't know what their plan is yet, unfortunately. I know it's been at the 500,000 limit for a couple of years now.
Yeah, it's scheduled to be.
50,000, right? They just,
Yeah, the 50 was the temporary, and then they bumped it up to the permanent 500.
And
So.
it's been that way, it's scheduled to be permanent.
Anyone else? Yes.
So when choosing a business structure, I know it depends on the industry, but somebody that would come to you guys as a new entrepreneur looking to start a venture, what process do you run them through in terms of deciding on which type of entity they want to, or structure they want to set up?
So you may want to touch base with me afterwards and we can discuss in a little bit more detail. But essentially it's going to be, kind of the items that I touched on. It's going to be what is your goal for the business? What's your income tax level? How much do you think, the business is going to be making, breaking net income wise? You want to consider liability protection. There are a number of factors, so if you want to touch base afterwards, just let me
And
know.
some industries are kind of regulated to what kind of structure they can have, so that's where that also comes into play.
Right.
Anyone else? Stephanie? Or- yes.
One thing I wanted to ask about too was on the ones about the, what you had back there, and I'm trying to remember exactly where it was. It was about the, giving, up to $12,500 per person on a gift type of situation. I think it was 12.5, wasn't it?
Oh, the 14?
14.
14, excuse me,
Yeah.
14. Now, go to the next one, I think it is, and you have about the, maybe where it was about like selling a property or gifting a property.
Correct.
You haven't, in that case, how do you work that out? I'm confused. And the way I'm saying that is because you just don't gift it to them and then you say, oh, it's only worth so much. You must have to get appraisals, you must have to, that type of thing.
Right, yes.
And in turn, from that standpoint, you have to figure out, you can't just gift them a property, can you? Because all of a sudden, maybe the gain is more than 14,000. And then, of course, what happens to above that?
Right.
Yeah.
So that is a great question. Let me go back. So we do have, you have the 14,000, which is an exclusion. So let's say I gifted a property that's worth, $1 million.
Mm-hmm.
Okay, so I have the 14,000 or possibly the $28,000 that I can apply towards that. But I also have this exemption. So that means that there's no tax as long as I'm under that exemption. It utilizes it, so it would go from the 5.45 million, down to the 4.45. But that would be a way where you're going to get the benefit of not having to pay tax on that gift. And you are correct that if I'm gifting a property, so I said you do want to consult with your tax advisor. There's a number of factors, involved. It's not something, even this close to year end in terms of gifting property or, an investment in a business or partnership that you'll be able to complete by year end, because there are appraisals, that are often needed.
I guess I'm confused because you're only supposed to give 14,000, but all of a sudden you're gifting a
No,
$1
you're
million
not
property.
supposed.
I mean,
You're not
that's like-
supposed to just give 15,000. That's just
Okay.
that's just the exclusion that you have.
Right,
So I
so-
can gift up to 14,000 and it doesn't hit that exemption. So
But
there.
then after that, then they are taxed.
No, then it goes against the exemption and starts decreasing that. Once you've utilized that exemption, you're
Oh.
taxed after that.
Okay.
Does that make more sense?
Well, then it's like as if you passed away and you got 5.45 million that you can, that's exempt from.
Correct. Once you pass away,
Yeah.
you do have that, but like I
But
mentioned.
you can adjust it beforehand if you wanted to yourself.
Correct, as
I
I'm-
wasn't aware of that, okay.
As I'm gifting now, it does utilize that exemption now, so there would be less, at my death in terms of the estate tax.
This is my daughter, I don't expect to get that. What are you thinking?
But no, that's a great
Don't hit
question.
me up on Christmas.
Is there any other questions?
Okay. I'd just like to encourage everyone to please fill out the survey. We use all the answers from the surveys to formulate our plans for next year in terms of what topics you'd like to see or what written content you'd like to see. So please leave comments for there, and you can just leave them on the desk, so I'll pick them up afterwards. And
Thank you to Stephanie and Nichole and Chelsey. A round of applause for them for as I said, we appreciate our relationship with Wiebe Hinton Hambalek, and we